I'm Rob Duncan, Senior Vice President and Portfolio Manager here at Forstrong Global. And today I'm joined by our CEO and CIO, Tyler Mordy from Kelowna. Tyler, how's it going today?
Great, Rob. Really pleased to be doing this live for the first time. So excited about it.
Yeah, and today we're very happy to bring you a new segment. We've done a lot of writing, as most of you are familiar with our portfolio dashboard, Ask Forstrong, and Super Trends. Today, we're going to bring you some video content. So today is the first segment of Ask Forstrong Live, and we're having a little bit of fun using our Zoom account. So as you can see, I've got a fun little background here, whereas Tyler's doing it in his basement. And hopefully we can work out all the kinks, and hopefully this all comes through quite smoothly. But for today, we're going to be doing a segment that talks a little bit about or answers some questions from advisors. As you're all familiar, we love to work very closely with advisors. And when you have a question, we like to answer it to try and make life easier for you and for your clients. So today's question kind of relates to what's happening in markets. And the big question is around how can stock markets be soaring when we have depressionary-like economic conditions, COVID, potentials of a second wave of COVID, US riots, and raising geopolitical tensions. And with that, I'm going to hand this over to Tyler. And Tyler's going to talk a little bit about what we see driving the markets and our outlook, and kind of some comments around what you should be sharing with clients. So with that, Tyler, please take it away.
Okay. Thank you, Rob. And we're going to try and keep this quick. But first of all, I think the fact that there's this broad disconnect between markets and the underlying economy that people are wondering about. And first of all, the first thing I'd say is that the fact that markets are hitting new highs is somewhat of an illusion. And what I mean by that is the market, so to speak, is typically the S&P 500 that people refer to. And that the performance has been totally flattered by the top five names, which is generally U.S. technology that account for about 20% of the S&P 500. So it kind of that good performance drags up the overall index and masks the underlying carnage that we see around the world. And that's not only within the S&P 500, but also and within the S&P 500, you still have energy, financials, industrials down major double digits during the year. But you look abroad and you see that there's a lot of global stock markets that are still down 30, 40% around the world. So there is a disconnect, but it's not as aggressive as a lot of people think. Now, we've written a lot over the last 3 months, let's say. And if you're following the Ask Forstrong series, you know that we love to write. We love to bring out the salient points to our clients. But during March, I think we wrote 4 or 5 Ask Forstrong series. And we focused on the behavioral aspects of what was happening with the market. Now, in March, we did think there was a financial panic. We did think there was a lot of overreaction. We did think there was a lot of indiscriminate selling across the board. We're talking specifically vis-a-vis international markets. And since then, so we've had this major financial panic where expectations collapse, stock markets collapse, and everything just the outlook becomes very cloudy and very negative. And since then, what we've seen is that the underlying economy, the virus developments, policy responses have not been as bad as the predictions would have suggested. Now, this is why a market can continue to rise, because markets don't care about good or bad. They don't function on those levels. They function on better or worse. Now, there's a chart that I wanted to show here too, just to show you, we've had this major rally. Some markets and some asset classes are up 50% or more. And we still have a broad level of pessimism. This is a survey that we follow from Bank of America, and it surveys a number of professional fund managers. Surprise, surprise, they get it wrong sometimes too, because it's a bit of a contrarian indicator at times. But it shows you that still 68% of professional investors still believe that this is a bear market rally. Now, there's so many things that would refute that right now from our perspective. But sticking to the behavioral aspect, we still have terrain where data can surprise on the upside. Last Friday, for example, we had one of the biggest misses in history, where versus the U.S. employment numbers. So economists forecast that unemployment would rise from 14.4% to near 20%, and it actually came down to 13.3%. The U.S. created 2.5 million new jobs. So we're in that market stage where we're climbing the wall of worry. And you can continue to have upside surprises. So that's on the economy. The virus is actually turning out a little bit better than most people think. The data that's coming in shows that it's less lethal than original forecasts would have suggested. We're seeing regional flare-ups, but those seem to be contained, and we're more prepared for those types of things. And but I think one final point, Rob, that I haven't talked about, which is really important, is the policy response. Now, it only took 3 weeks in March for all of the policy apparatus that we took 18 months in the global financial crisis of 2008 to be brought forward, to be presented to the world during March. So 3 weeks versus 18 months, all the same policy apparatus. That's quantitative easing and reduction in interest rates and so on and so forth. And now I think the big surprise that we're working on right now, and this is our base case, and a lot of people debate whether the policy will be enough to plug incomes and revenues, corporate revenues, that is. I think the big surprise as you look out 12 to 18 months is that not only will it be enough, it will actually overcompensate. And we'll see interest rates that are probably too low. Fiscal stimulus that has come out of the bottle and is too aggressive relative to the underlying economy. And so, I think something to think in mind, Rob, is that it's the virus is the problem, not the economy. When we went into this, the economy was actually doing pretty good. There were no major global imbalances. And so if we can get a vaccine and some treatments, then the economy generally can go back to trend line growth, that is. But then you think about all the stimulus that's been poured onto it, and you'll see that we could actually have pretty good growth for the next few years after we come out of this. And that's going into end of 2021, 2022. But again, I think investors should tattoo this on their foreheads that markets are forward-looking. They don't price the world as it is. We see carnage everywhere right now, but they don't price the world as it is. They price the world as it may become at some point. And so I think that's what we got to keep our eye on that ball. But I don't want to present a blindly optimistic view. Our investment team continues to monitor the situation. There are several risks. I think COVID has accelerated and brought the future forward, as we've all been discussing in terms of technology and working from home and those types of things like we're doing right now. But it's also exposed a lot of structural flaws in the world economy. And I think Europe would be the epicenter for that right now. Europe has always struggled with this monetary union without a fiscal union. And there's some tests there. So future Ask Forstrongs will be definitely talking about the situation in Europe and, really looking at the world through a tripolar lens. I think you can, if you want to understand macro, you have to understand the US, Europe, and then Asia. Those are the sort of three major economic ecosystems of the world. So the disconnect, in short, the disconnect is not as glaring as it may seem. And I think, one of the things that we do at Forstrong is really focus on the behavioral aspect and focus on upside versus downside surprises. Is the economy and our developments getting better or worse? And that's where our investment team is always focused.
So I think we covered a lot very quickly, and in the efforts to keep this short and to the point, I think that was fantastic. Just to recap, I think the world was doing quite well coming into COVID-19, the pandemic. This is a pandemic crisis. This is not a financial crisis. The stimulus measures that have been put in place, in our view, were quick enough and large enough to help and create this to be a quicker recovery. Still a lot of pessimism out there. So there's a lot of people on the sidelines, potential for FOMO or fear of missing out, which would be late money, which would then further accentuate this recovery. And then even to your point, looking further down the road, talking about future economic gains, kind of once you have stimulus in place, it's kind of hard to turn it off. So once the economy recovers, there's still going to be the stimulus in place pushing things forward. So that's a quick recap. I just want to say thanks to everyone that's watching this video right now. I hope it all turns out well. Keep an eye out for more of this in the future. And if you like the video, you're going to love a lot of our writings. So please take a look at our monthly dashboard, our Ask Forstrong written pieces. And for those that love podcasts, we do have a Forstrong Global podcast as well, with a new one coming out shortly. So with that, I want to say thank you very much for watching. And Tyler, thanks again for being our first guest on Ask Forstrong Live today.
Thanks, Rob, and thanks to all our clients.
Thanks, everyone. Stay safe out there.